Improving your credit score can have a huge impact on your finances. A good credit score makes it easier to borrow money for a major purchase, like a home or vehicle, and qualify for the best interest rates. What is a credit score? At its core, a credit score is a numerical representation of your creditworthiness. It is a measure of how likely you are to repay borrowed money based on your past financial behavior. Credit scores typically range from 300 to 850, with higher scores indicating a lower credit risk and vice versa. Lenders, such as banks and credit card companies, use these scores to evaluate the risk of lending money to individuals. 10 ways to improve your credit score in 2024. If you're ready to start improving your credit in 2024, follow this roadmap. 1. Look for errors on your credit reports. Your credit reports won't show your credit scores, but they're the source of the information that's used to calculate your scores. If you discover errors and have them removed, you might see your credit score go up. While you can access a free credit report weekly via annualcreditreport.com, it's typically unnecessary to check that frequently. A yearly review is advisable, or more frequently if planning a major purchase. Additionally, monitor reports after data breaches or suspected identity compromise. Check for errors in personal information, unrecognized accounts, incorrect payment statuses, inaccurate balances/limits, duplicate listings, and unauthorized inquiries. If errors are found, promptly dispute them with the relevant bureau. Your credit report will provide information about how you can do so. 2. Pay your bills on time. The most critical factor in building a good credit score is making timely payments, as payment history holds the highest weight in credit scoring. Just one late payment, defined as 30 days overdue, can significantly impact your score. Late or missed payments typically linger on credit reports for 7 years, with their influence diminishing over time. Payment history only accumulates for accounts reported to credit bureaus, such as credit cards and personal loans. Unfortunately, timely payments for utilities or phone bills rarely affect credit scores since they're seldom reported. However, delinquency leading to collections can harm your score. 3. Ask a loved one to make you an authorized user. An authorized user on a credit card is someone who has permission from the primary account holder to make purchases, but isn't responsible for payments. Becoming an authorized user on an account owned by someone who has good credit can give your credit a lift. On the flip side, it could hurt your credit if the account holder misses payment or maxes out their card. If you have a loved one who's financially responsible, ask them if they let you piggyback on their creditworthiness by becoming an authorized user. Just don't abuse the privilege if they say yes. Get their permission before actually making any purchases with their card. 4. Get a credit card if you don't have one. Building credit without a credit card is tough, yet getting approved for one is challenging. To start, consider secured cards, where a deposit sets your credit line. Some offer upgrades to regular cards with timely payments. Unsecured starter cards are available for those with limited or bad credit. Store cards, usable only at specific retailers, often have lenient requirements. Student cards cater to those with little credit history. Initial cards typically have low limits and high APRs due to perceived risk. Pay off balances promptly to avoid interest and maintain a credit utilization rate below 30%, crucial for a healthy credit profile. 5. Look for a credit builder loan. You can also establish credit through a credit builder loan, which is like a loan in reverse. You pay your financial institution each month, and they report the payments to the credit bureau. But unlike a regular personal loan, you get the money at the end of the term after making all payments, instead of the beginning. Credit builder loans typically have terms ranging from 6 to 24 months. You're most likely to find them at smaller community banks and local credit unions. 6. Request a credit limit increase. Once you've proven your creditworthiness, or if you already have a credit card and a solid payment history, consider asking your card issuer to increase your credit limit. By having more open credit, you'll automatically decrease your credit utilization as long as you don't increase your balance. You'll typically want to wait at least 6 months before making this request, though. 7. Get your rent payments in front of the credit bureaus. Most landlords don't report rent payments to credit bureaus, so good rental history won't typically boost your credit score. However, if reported, it can impact it. Some rent reporting services relay payments to bureaus, often requiring landlord enrollment and a fee. This fee, though, may be worthwhile to showcase timely bill payments. Credit scoring models vary. FICO's newer versions consider rental payments, unlike older models for mortgages. VantageScore includes rental payments in all its models when available. Overall, actively reporting rental payments can positively influence creditworthiness, but it's contingent on landlord cooperation and the chosen credit scoring model's criteria. 8. Avoid closing old credit cards. Because length of credit determines 15% of your credit score, avoid closing old credit cards unless you have a compelling reason, like the card has a high annual fee. Even if you have other credit cards with better rewards programs, use your older cards for the occasional purchase or a small recurring bill. 9. Pay off debt strategically. Not all debt payoff benefits your credit score equally. Paying off your credit cards usually helps your score more than paying off loans. That's because when you pay off a credit card, you lower your credit utilization, which is the second most important credit score factor. Since credit cards typically charge higher APRs than loans, you can also save money on interest. However, if you have any loans that charge exorbitant interest rates, pay those off first before you tackle credit cards. For example, payday loans frequently charge APRs of nearly 400%, which can leave you trapped in debt. Your credit score is unlikely to benefit from getting rid of payday loans, as most lenders don't report to credit bureaus, but your personal finances will be much healthier for it. 10. See if a debt consolidation loan will save you money. A debt consolidation loan is a personal loan that you use to lump several high-interest debts into a lower-interest loan with a single monthly payment. For example, if you had 3 credit cards with interest rates of 16%, 18%, and 21%, but you qualified for a personal loan with a 10% APR, consolidating debt with a personal loan could save you money. Since you'd lower your credit utilization, your credit score would likely benefit as well. Considering that interest rates are at a 22-year high going into the new year, so 2024 may not be the best time for debt consolidation. But if you're juggling multiple high-interest credit card accounts, you could still save money and improve your credit score. Make sure you consider the interest savings from debt consolidation for the long term. Some debt consolidation loans lower your monthly debt payments, but cause you to pay more interest over time because they have longer repayment terms. Your credit score is a powerful financial tool that can either work for you or against you. By understanding how credit scores are calculated and implementing proactive strategies to improve yours early on, you can set yourself up for financial success and security. Cultivate good credit habits, monitor your credit regularly, and be patient as you work towards achieving and maintaining a stellar credit score. Remember, the journey to financial empowerment begins with a single step, and mastering your credit score is a crucial milestone along the way. Thank you for watching, and don't forget to like and subscribe.